Okay. So, here's some announcements for us to talk about. Our final exam is on Tuesday the 25th, and that's from 4 to 6. Are you guys in the back? Are you with me? You here? Okay. Our final exam is on the 25th from 4 to 6. And it's going to be comprehensive. As I mentioned before, more of the points will be on the material since the second midterm exam. And please bring your computer, but when you solve Excel problems, you're going to have to start with a blank workbook. And so my recommendation is to go through the in-class exercises that we've had so far this semester. Think about in what ways have you used Excel or other tools to solve different types of analysis problems, and then if you guys need to go study somewhere else, that's totally fine. I mean, you've got credit for being here, so if you've got other things you need to do, that's okay. So today we're going to talk about taxes, and this material will be included on the exam, but of course you're not going to have a homework assignment, and so it's probably going to be more conceptual questions that you'd face on the final exam related to the taxes. So regarding those three equation sheets that you prepare, you don't have to include these time value of money equations because I'll provide those. And so it should be maybe just more reminders on different types of things like external rate of return, cost-benefit calculations, and so on. Okay, now we're going to talk about several different types of taxes today. And one of them is an excise tax, which is a special tax that is applied not on all activities or not on all different types of products, but it's applied onto individual things. And so, like, there are special taxes on cigarettes, on alcohol, on fuel. And so when there's a tax that only applies to one certain kind of an item, it's known as an excise tax. And oftentimes those are thought of as, sometimes they call them sin taxes, because often excise taxes are special taxes that are put onto things that people don't necessarily need to have, like liquor, cigarettes, or even in the case of gasoline, it's considered maybe a non-necessity because there could be some other transportation alternatives. But the purpose of excise taxes is often to recover special money that is related to the negative externalities that arise from those things. And so in the case of cigarettes, a lot of the taxes that are collected on cigarettes in the United States go into special health care funds. Same is true of alcohol taxes. In the case of fuel taxes, those funds are collected and put into roadway improvement, both at the federal and the state level. Sales taxes we're all familiar with because we pay plenty of that along the way. Every state is a little bit different, though, in what they include on sales taxes. There are some states that include food in the things that sales taxes due on. Other states don't charge sales tax on food. In some states, sales tax is charged on services as well as goods, whereas some states only charge it on goods and not on services. So, for example, if you were to get a pedicure or to get a massage. Some places, there are states where you don't have to pay sales tax on the services. And of course, there are some states, a few of them, that don't have any sales tax whatsoever. Property taxes are commonly collected on big ticket ownership items like homes or, in some places, vehicles. And the purpose of that is usually to fund local education initiatives. Here in Cabell County, the property taxes fund schools, it funds the public health department, some senior programs for like nutrition or like adult daycare type things. And unlike income taxes, which we'll talk about today, where you have to actually have some profit or some income, property taxes are always due regardless of whether the equipment is in use or not. So, for example, if you own a piece of land and you're not living on it and it's not generating any income, you'd still have to provide property taxes even if you're not using it anyway. And that is why, in part, property taxes can become a burden for elderly people whose income is really low, is because later in their life, when they don't have income, they still may have taxes due on the property that they own. So some states have caps on how much property taxes can go up to shield older people from the rising property taxes that would maybe bankrupt them or make them have to sell their homes and move out. Here in West Virginia, there's a little bit of a reduction on the property taxes for elderly people, but it is still due. Income tax, go ahead, Victor.
What about having a car, the taxes you have to pay? Will it get in property taxes?
Yes. Yeah, here in West Virginia, you have to pay property tax on your car. But when I lived in Ohio, I didn't have to pay property tax on my car. You'd just pay maybe like a small registration fee each year, but not a property tax. Yeah.
A lot of people around here have Ohio plates, but they live in West Virginia, so they can kind of get around that.
Yeah.
I've noticed.
Yeah, right.
My switch.
Yeah. Now, we talked about income taxes when we were discussing depreciation and how the reduction in value of equipment over time can be deducted from the income taxes. But income taxes vary a lot from country to country in who has to pay it. Because here in the United States, if you're a citizen of the U.S., you have to pay income taxes even if you're living outside of the United States. And that's pretty uncommon. Most other countries don't charge taxes to their citizens if they're living outside of the country and not receiving the services of that country. So that's kind of a unique, unfortunate burden that we face here in the U.S. is those income taxes that follow you regardless of where you're living. But some states also add income taxes, most, and a handful of local governments. Here in Huntington, we don't have an income tax at the local level, but we have a city user's fee that we have to pay. It's just a couple of dollars each week, but it's not a percentage of your income. It's just a flat fee that anyone who works in Huntington has to pay. So this figure kind of just illustrates the variation in sales taxes from state to state. So it's showing, for example, if you're trying to save money, Oregon could be a good place to go buy things. And there are border communities in Washington, for example. Just over the border from Portland, Oregon, is Vancouver, Washington. And I would imagine that when people are doing, like, buying a computer or buying a car, well, you can't avoid sales tax when it comes to buying a car. But buying a computer you could, or a flat screen TV or something like that. You'd maybe drive over the border into Oregon to avoid paying the sales tax. Here in West Virginia, when you pay your income taxes each year, they ask you if there are any things that you bought outside of the state that you didn't pay West Virginia sales tax on. So they're expecting you to say, for example, if you have magazine subscriptions that you didn't pay tax on, or sometimes when you buy things online, not so much anymore, but in the past it used to be pretty common, even with Amazon, that you wouldn't pay any tax. And so when you file your West Virginia income tax return, they're also trying to collect any of the items that you bought out of state and didn't pay West Virginia tax on. So it varies a little bit. Sales tax isn't something where there's huge variation across the states. Excise and gasoline taxes, though, do vary quite a lot. And I notice this the most when I drive through South Carolina, because oftentimes I'll fly from West Virginia into Charlotte, and then Charlotte's in North Carolina, and you're just driving across the border, and the gas tax goes from 34 cents a gallon to 16. And so just right over the border, instantly you'll see like a 20-cent reduction in fuel costs. And so that is one of the things that kind of varies a lot. And even Pennsylvania, you'll notice that they've got 58 cents a gallon on the tax in Pennsylvania. And so there are probably border communities between Ohio and Pennsylvania, like Youngstown is right on the border of Northeast Ohio and Pennsylvania. And so you'd save 30 cents on each gallon of gas driving from Pennsylvania to Ohio. Cigarette taxes vary a lot from state to state, and the southern states that have a history of tobacco production are the ones that typically are less likely to have steep cigarette taxes. So if you'll notice that in Georgia it's 37 cents, Kentucky 60 cents, Tennessee 62. So that's relatively low compared to like New York State, which charged $4.35 for every pack of cigarettes. And so the effect of taxation is to reduce consumption. It's been proven that when taxes are raised on something like cigarettes that's a non-necessity, that there will be some fraction of people who choose to stop smoking because it's no longer affordable. So that's one of the purpose of taxing something that has negative effects, would be to discourage consumption. But then, as I already mentioned, it's to raise revenue for the health care costs that a lot of times the state is going to have to pay through Medicaid or through state-funded hospitals when people who smoke and get cancer can't cover their medical costs. And so that's part of the reason for these specific excise taxes. This is just showing like the sum total of all excise taxes, and so this includes on a state-by-state basis related to tobacco, alcohol, and fuel. And so there are some states that rely a lot on excise taxes, like Vermont. They're taking in $1,000 per person each year in excise taxes. And then there are other states where excise taxes are a much smaller portion of their revenue. So Georgia, South Carolina, you can see, are pretty low. Arizona is the lowest at $300 a person. So picking which state to live in is, for a lot of people, related to the taxes that they'll face. And there's a growing number of ultra-wealthy people in the United States who are choosing to be based in Puerto Rico because you can live in Puerto Rico and it's considered a U.S. territory, but the income taxes and all of the other property taxes are much, much lower in Puerto Rico than they are in the continental United States. So one kind of tax that we don't have in the U.S. but is very common elsewhere in the world is the value-added tax. And value-added taxes are usually put into place instead of a sales tax. So for example, in Canada they have the VAT. In much of Europe they have the VAT. They just recently added it over in the United Arab Emirates, which until the VAT was added had absolutely no taxes. But it's still relatively low over there. The VAT is a little bit complicated, and the way that it can be explained is that every step in a process, people are paying some portion of the tax. Whereas right now, when you pay sales tax, you're the only person who is carrying that economic burden. Whereas the grocery store didn't have to pay tax to the supplier that it bought the food from. The supplier didn't pay tax when they bought food from the grower. The grower didn't pay tax when they bought seeds from their seed supplier. And so in the United States, where we have a sales tax program, it's just the end user who pays all of that burden. Whereas the main idea of a value-added tax is that it spreads out that taxation over multiple people. And in doing so, it reduces the risk that there will be people buying things on the black market to avoid tax. And so let me explain how it works. Just kind of stepping through this, I think, will make you see the way that the VAT operates. Let's just say that there was a 10% tax rate that applied. And the reason it's called value added is that every step in the supply chain, somebody is doing something that makes the product more valuable. So for example, when a farmer grows cotton and sells it to a textile maker, the textile maker is going to turn that raw cotton into fabric. And so they're going to be transforming the raw cotton into fabric, and they're going to be adding value through that transformation. And so what happens is, if the item sells for $1, the farmer has to charge $1.10. The farmer will keep $1 and owes 10 cents to the government because it's 10% of their sales go to the government. And so the textile maker paid $1.10, and they're going to take that cotton that they paid $1.10 for, and they're going to transform it into fabric that has a value of $5. And so if you think of what's the difference between the $5 value and the initial purchase price of $1, they've added $4 of value, so they have to pay the government 40 cents on that $4 in value that they added. So actually, when they're selling it to the next person, to the clothes maker, they're charging the clothes maker 10% of the $5. And so they're charging the clothes maker $5.50 total, because it's the $5 for the fabric, 50 cents for the tax, but they only have to give the government 40 cents because they're getting reimbursed the 10 cents that they paid in the prior step. And so they only are paying tax on how much value they added, which is the difference between the purchase price and the sales price. So even though they charge 10% of the sales price, they're reimbursing themselves for the other 10 cents that they paid in the first step. So it's only on the value added, the difference between what you sell it for and what you bought it for. So the same thing is true in the case of the clothes maker who bought the fabric for $5 and sells it for $12. The difference there is $7, and so they have to pay the government 70 cents in tax, but they're charging 10% of the sales price in tax. And so they're charging $12 for the item plus $1.20 in tax, and they're keeping 50 cents to reimburse themselves for the 50 cents that they paid in the previous step. So they're only paying a net tax of 70 cents because that's the difference between what they bought it for and what they sold it for. So at each step along the way, even though the item is, the total sales price is the item price plus 10% for the total of the tax plus the item, the government is only taking 10% of the amount where the value is added. So it kind of spreads out the burden, you know, instead of the consumer having to pay the full $2, the consumer would only pay 80 cents of the tax. So it's kind of, I don't know, maybe a little bit more fair because everyone in the step, every step in the chain got benefit from what was happening. Everyone is benefiting from the transactions, and so everyone is paying kind of a share of the tax to the tune of how much they benefited. So that's kind of an interesting concept, the value-added tax. So let's talk about property tax, and the property taxes here in Cabell County are a good illustration of what's true in a lot of counties in the United States. So the tax rates are available on the Cabell Assessor's website, and let me just show you something that the tax rate is different depending on where you live in the county. So, for example, a house that is in Huntington that is owned by the occupant has the tax rate of 1.71. And basically the way that works, that 1.71 is the, you take the 1.71 and multiply it by the assessed value and then divide by 100, and that tells you the property tax. And so it's basically 1.71% of the property value is how much tax you have to pay each year. And the assessed value isn't actually like it's not what it would sell for, but it is, the assessed value is more related to, there is someone here in the county called the assessor, and they give you like a rough idea of over a few years how much the property is worth. And you know, property values go up and down a lot from year to year. And so it's kind of a more stable, this idea of the appraised value. So a house that today maybe sells for $280,000, it may have an appraised value from the Cabell assessor of $250,000. but then the assessed value is only 60% of the appraised value. So now, once you have this assessed value, if it's owner occupied, then it would be $1.71 for every 100 of value. But if it's occupied by a renter, then the property tax is higher. So like if you're a landlord in Huntington, you have to pay more property tax than someone who is living in a home and they're just occupying it for their own purposes, you know, like if they're living there. And in certain ways, that's kind of unfair to renters, because what a landlord is going to do, obviously, is just put the property tax on whoever is occupying the house. And so this policy of having one rate for resident landowners and another rate for rental properties, I think you could think of it as a tax on people who are renting that isn't, it's having a higher tax for people who rent versus who don't rent.
What would zero tax mean?
I don't know which properties are class 3. The only thing I can figure is maybe those could possibly be like churches or nonprofit organizations that are exempt from paying property tax. But I don't know specifically. I only know the difference between, like, class 2 is owner occupied and class 4 is renter occupied. So in rural areas, I don't think that those same classifications, like categories, exist in rural areas, but the higher rate is always for renter occupied properties compared to owner occupied properties. And so the same thing is true in Barbersville, but it's kind of interesting that Barbersville and Huntington have higher tax rates than the rural areas do. And do you know why that is? Why there's more property tax in people who live for Barbersville or Huntington?
Because of the location, maybe?
It is because of the location, but specifically why? Like,
Barbersville's a village.
it's a village?
That's why.
Yeah. I think it's mainly because they have their own fire department, their own police department. Whereas people who live in rural areas in Cabell County have to rely on the county sheriff for law enforcement, and they don't have a professional firefighting department. They just have like volunteer firefighters. So like I had a fire at my house a couple of years ago, like some leaves caught on fire, and the volunteer fire department came out and did a great job, but I mean, they just operate strictly on the basis of donations. And so ever since they came to my house, every year they send a request for donations, and I've always paid it even before that. But nobody's obligated to pay the volunteer fire departments, whereas if you live in city of Huntington or city of Barbersville, they collect additional taxes above and beyond what the county charges. Milton also has, it's an incorporated area within the county. Those are the only incorporated areas in Cabell County, is Huntington, Barbersville, and Milton, and then anything that's not in those city limits is considered the rural areas of the county. So these rates, these tax rates, just as an illustration of how it would work, if there was a home that was owner occupied in Huntington, the fact that it's owner occupied gives you the rate that you'd have to select. And then if a house was $150,000 was its appraised value, it would have an appraised value of $150,000, and maybe its actual market value could be $200,000 today, $220,000 next year, $180,000 the year after that. The market value changes a lot, but the appraised values usually only change maybe once every 5 years. So it's more stable and people aren't getting jerked around from year to year. But the assessed value is 60% of the appraised value. So if it was appraised at 150, then the assessed would be 90, and so then you'd pay 1.65% of 90,000. So the property tax would be $1,486 per year. But remember, this same person in Huntington, if you were renting a house that had a value of $150,000, then it would be $90,000. And what was the renter rate in So for Huntington, 3.42, 3.4224 out of 100. Okay, so instead of $1,486 a year, then the property tax would be 3.4224 divided by 100, 3,080. So 3,080, 16, and your landlord isn't paying that out of their pocket. They're just passing it along to whoever's renting the place. And so it's double. It's more than double, and you're not getting any more services. You're still using the same schools, using the same sewers, same police, same fire protection. So I kind of view it as an unfair tax, obviously. I think it should not necessarily, and I'm not a landlord, so it's not like I have any skin in the game one way or the other. So income tax is one of the biggest tax burdens that people face in the United States, at least individuals, most working individuals. The income tax is the biggest tax that they'll pay. And for the first 100 years of the United States existence, there wasn't any income tax. It was first instituted back in 1861 to pay for the Civil War, and it was only 3% back then. It was only 3% of income over $800, which in those days, most people earned less than $800 per year. So it was kind of a tax that only applied to the very wealthy, and it was even reduced to 2% after a couple of years. But eventually it went up to the rates that we face today. We're going to look at and talk about progressive income tax rates. But earlier when I was talking about how the United States is the only, well, it's one of just a very small handful of countries where you have to pay the tax regardless of where you're living. All these other countries that are shaded in dark blue are the ones where if you are living, for example, if you are from Chile and you're living in the United States, then you don't have to pay tax to Chile while you're in the United States. Ironically, Paraguay does. My son lives in Paraguay right now. So it has taxation that you'd have to pay both to your home country and to Paraguay, like the country you're living in and Paraguay at the same time. So income tax can't be escaped, and this is what's known as tax brackets, because we have a progressive income tax system in the United States. Progressive means that the more money you make, the higher the income tax rate becomes. So for example, if your taxable income is between $0 and $10,275, then you pay 10% of what your income is when you're in that range. Now, if you make $10,276 to $41,775, the tax rate is 12%. And this is something where people oftentimes get confused and they fall into some mistaken thinking. Because I've known people who thought that it's better to make, for example, $10,000 than $11,000. Because they are thinking, well, if you only make $10,000, then you're in the 10% range. But if you make $11,000, then you have to be in the 12% range. But that's not how it works. If you look at this final column on the right, it's only the 12% applies to the income that's above the $10,276 range. And so your first $10,275 is taxed at 10%. Then every dollar you make within this range is taxed at 12%. So over here on the right, it says that the tax that you owe if your taxable income is in this range would be $10,027.50, because that is 10% of the top end of the first bracket plus 12% of everything over $10,275. So, for example, if you're doing pretty well, maybe if you're like a doctor or something and you're making $600,000 per year, then you'd pay 10% on your first block of income, 12% on the next, 22 on the next. So these fixed dollar amounts that is listed in the final right column, it's basically adding up all of the progressive tax that you have to pay up to that point. So somebody who's making $600,000 per year, they'd pay $162,718 because that would be the tax that's due for their first $539,901. But then the remaining $60,100 would be taxed at 37%. So there's just two big caveats, and that is that taxable income and your actual income can be two very different things. There's all sorts of tricks and gimmicks people can use to bring what would look like their income down lower. So for example, people who are business owners will oftentimes, if they go to a restaurant, they'll just say that their meal was a business expense, whether or not it's a business expense. There's plenty of small business owners who every time they eat out, they keep the receipt, and then they just say, well, I was thinking about business while I was at the restaurant, so this meal is a business expense for me. Or I was entertaining clients. And maybe your client is your wife, and you're going out to, I mean, it's not technically supposed to be that way, but unfortunately, well, maybe. I don't know if it's fortunate or unfortunate, but very few people will ever get audited. The budget of the IRS for audits to actually enforce the tax laws is so low that what a lot of people know is that they can cheat on their taxes and that they're most likely not going to get caught. So as long as you've got a receipt, the IRS, number one, is not likely to ever audit you, and number two, they're not going to start interviewing people to see who was at the restaurant with you. They're not going to necessarily call witnesses and all that. It would be pretty uncommon for them to be able to prove one way or another if it wasn't a justifiable expense. And so, you know, people will sometimes buy things for their hobbies and count that as a business expense. You know, like if somebody really enjoys computer games, they could buy a really expensive gaming computer and then just say, well, I need a computer for my business, even though they don't probably need like a graphics card or a webcam for streaming and that kind of thing for whatever their business is. So that's one thing I want to talk about. We're going to go through a 1040 here in a minute just to see some of the things that can differentiate between your actual income and your taxable income. But the other thing is that these tax brackets are different whether you're single or married. And so this is the tax brackets for the single people. Let's take a look at what they are for married people, because a lot of people complain that in the United States there is like a penalty for being single, that that the tax system favors people who are married. So for example, if you are single, then this is the tax brackets, like 24% applies to 86,000, that's 89,000 up to 170. All right, so if we look at though the married filing jointly, the 24% bracket doesn't go from 89,000 to 170, it goes from 178 to 340. So what it does is it allows you and your spouse to make more money together and pay lower taxes than a single person who is making the same amount of money. So it's kind of, a lot of people consider it a penalty on someone who's single, because if you're married but your spouse doesn't work, it's kind of like you guys are getting a discount on your taxes compared to someone who makes the same amount of money but they're not married. So that's one of the criticisms of our income tax system, is that there are higher limits for the people who are filing jointly. So the other thing I wanted for us to do today is to go through the 1040, because maybe some of you have filled your taxes before. A lot of people just rely on a tax preparer and don't necessarily ever interact with it themselves. And so I just wanted to go through it so that we can demystify some of the things they're asking about and talk about some of the terminology that's included on the form. One of the new things that, obviously at the top it's just demographic stuff. It's asking for your name and your social security number. It's asking whether you're going to be single or married filing jointly. And there are legal definitions for all of these things, like head of the household, qualifying surviving spouse. And this is Form 1040, but the IRS also has instructions. And the instructions for this is like a 2-page document. The instructions are dozens and dozens of pages long with lots of extra definitions and stuff. And so all the online companies that exist to help you file your taxes, mainly what they're doing is they're just explaining these different things in language that's easier to understand than the IRS instructions do. So one of the things that's new just in the last 2 years is the IRS is asking you to declare whether you have digital assets. And they didn't used to do that, but it's a new thing related to cryptocurrency like Bitcoin, for example. So they're asking you if any time during the year did you receive or sell a digital asset. And so they give you a definition of a digital asset. It basically means like EFTs, ETF.
NFTs?
NFTs, yes. I was thinking exchange traded funds, but no, non-fungible tokens. Yes, NFTs or cryptocurrency is what they mean by digital asset. Now, they don't ask if you own it. So you don't have to say yes just if you hold it and you didn't do anything during the year. They only want to know if you got the digital currency or if you sold the digital currency. Like if you got it for work, if you got it by buying it, if you got it as a donation, however you got it, they want you to say yes so that they can keep track of you and know in some point in the future, if you sold it, you're supposed to pay tax on any income that is generated from the appreciation on the price. So if the price goes up, you have to pay income taxes on the amount that the digital assets go up. Back in a few years ago, I sold some Bitcoin that I had mined years and years before that. I mined Bitcoin back in like 2011, and then I just held on to it until 2017, and then I sold some. Back then, it didn't ask you on the tax form if you had it, but you had to find some other place to declare that income and pay tax on it. So I did that. I paid my taxes on the digital income that was generated. Now, this next part of standard deduction, there's basically 2 routes that you can go down when you're paying your taxes. And one is that you can keep track of all of your deductions, like if you have medical expenses over a certain amount, if you have made donations to charity, like if you've paid money to your church, or if you've donated money to the university, or given clothes to Goodwill, all the donations that you make, you can add all of that up. And if it's more than the standard deduction, then you can deduct the value of all of those donations and deductions. Or you can just take the standard deduction. Over here on the side, it says the value of the standard deduction. So if you are married filing jointly, so like if you and your wife or husband are filing the taxes together, then the deduction is $25,900, and that is how much money you can pay without having to pay tax on, or how much money you can earn without having to pay tax. So if you make that much or less, then your taxable income is going to be 0. So people really like to maximize their deductions because that is reducing the amount of tax that is due. And then on this part of the form, you just list all the dependents that you have, because there's also a deduction that comes from having dependents. And if they're children, then you can get a tax credit of a few $1,000s. It's not worth having kids just to save money, because in the end they cost a lot more than the value of the tax credit. But I guess if you've got them anyway, it's good to take the tax credit. So here on income, you're listing the amount of money that you make basically from work. And if you have like tip income, you're supposed to report that. So people who work in restaurants or deliver pizzas or maybe drive Uber, all of the tip income that you have is supposed to be declared here. If you have certain kinds of benefits that can be taxable, like if your employer pays childcare expenses, or if your employer provides a company car, that is considered a taxable benefit if you drive it for like personal travel. If an employer provides housing, but it's not a required benefit, like there are some employers who provide housing, but you have to live there as a condition of employment. So people like oil rig workers who live in the Gulf of Mexico, like you have to live on the oil rig in order to be working on the oil rig. And so the value of your lodging isn't considered a taxable expense because it's just kind of a required part of doing your job. But if your company keeps a fancy apartment for you and it's not required for you to live in that, then the value of the benefit that they give to you would be considered as income that's included on the 1040. So you also have to include interest that you make. So that would be like interest from bank accounts, or it could be dividends that you earn on bonds that you own, or if you are buying and selling stocks, like day trading. You may have heard the phrase day trading, where you buy it today and you sell it maybe tomorrow. You're not holding on to it for very long. If you hold on to stocks for less than a year, then any gains that you earn through doing that are taxed at just the rate of ordinary income. If you own stock for more than a year, then you have to only pay 15% because it's called capital gains. And so it's typically going to be lower than your ordinary income tax would be. So for example, the tax rate would be 22%, 24% if you're in certain ranges for ordinary income, but for for capital gains, it's at a lower rate. There's in your early working years, you're not going to have pensions or Social Security benefits that have to be reported, but once you've stopped working, there may be certain money that you get during retirement that has to be accounted for and declared on the form. And here you can see where they're identifying capital gains for any stock purchases, and then it says to attach Schedule D. So there's certain things on here where if you, for example, bought and sold stocks, the government wants to know the specifics of it. They want to know how many shares you bought, what day you bought them, what day you sold them, what was the price of the purchase and the sale, because they want to basically check your math to make sure that you did correct accounting on how much tax is due. So that's what would be on this Schedule D, is it's basically a separate worksheet where you show your calculations related to the profits that you made on stocks. And if you have itemized deductions, Schedule A here is where you would be listing the itemized deductions if you choose to itemize. If you do the standard deduction, then you wouldn't have to include Schedule A. So when you add up all those different kinds of incomes, then have subtracted out the deductions. So once you've subtracted out the standard deductions or itemized deduction, then that's where you come up with the taxable income. So what rich people who can afford really good tax lawyers, what they're trying to do is identify lots of deductions to try and reduce their taxable income as much as possible. Now, in addition to deductions, there's also credits. And a credit is kind of like the government paying the taxes on your behalf. And so deductions are good and credits are good, but $1 of deduction isn't as valuable as $1 of credit. because $1 of deduction is just reducing your taxable income by $1. And remember, you maybe only have to pay 22% of your taxable income as tax. And so if you get $1 of a deduction, then its value is maybe 20 to 30 cents. But $1 of credit is worth $1 in your pocket because it reduces the total amount of tax you owe by $1. So most people will have money withheld from their paycheck every time they get paid to go towards the tax that is due. The unfortunate thing is that if you don't have enough withheld, then you may have to pay a penalty to the government because obviously you're going to have to write a check to them for the difference if it turns out that your tax due is more than the amount that you had withheld through the year. In the same way, most people have a little bit extra withheld from each paycheck so that they can have a tax refund. I mean, everybody's probably heard or seen commercials where it talks about tax refunds. You're just getting your own money back. It's not like, in most cases, the government is giving you their money. They're just giving you back how much of your money you had given them above and beyond what was actually going to be due. So a lot of people don't want to have a refund. They just want to keep the money every time they get paid, so they try and get as close to possible as just the right amount. But then there can always be something unexpected, like you get maybe a bonus and you weren't expecting it, and so now you have more tax due than you're expecting. So you can either get a refund or you can have money owed. And if you owe the government more than $1,000, then they can charge you interest on how much you should have paid them through the year instead of paying it to them later at the end of the filing. So there can be a little bit of a risk if more than 1 year in a row you have tax due, and if it's more than a certain threshold amount, then you have to pay interest on top of the tax that's due. So a couple of other things that I'll mention here is the child tax credit, because that applies to a lot of people. The child tax credit is just an additional bonus for having kids that reduces the amount of tax that you've got due. And so a lot of the credits, though, are scaled out. Let's look, for example, Schedule 8820, because I want to point something out that is true for a lot of credits, not just for the child tax credit, but depending on what your income is, it phases out. So certain credits only apply when your income is kind of below a certain amount. So for example, it's kind of a complicated flow chart, but if you're trying to calculate the value of the child tax credit, then they're going to ask your income amount on here. So see how it says for married filing jointly $400,000, for all other filing statuses $200,000. So if you have an income above $400,000, then you're not eligible to take the child tax credit. And that same kind of thing applies for lots of credits, whether it's like an education credit or electric vehicle credits. They oftentimes have like an upper limit of how much money you can make and get the benefit of it. And so there's like some retirement incentives where the government is trying to encourage you to participate in an IRA. And if you make above a certain amount, then those kinds of credits will be phased out. So you can either get the check mailed to you, or you can add a routing number, an account number, and they'll just direct deposit it, and it comes a lot more quickly that way. And there is one other option, well, maybe two other options. So you can either have a check come to you, or they can do direct deposit, or as a third option, you can have the amount applied to next year's taxes if you think you're going to have a lot due. But on this Form 888, it also gives you the option of having it refunded to you as an I bond. And I think we talked about how I bonds are these bonds that pay really good interest rate, and there's a limit on how much you can buy each year. Let me show you on the Treasury website about I bonds. Treasury Direct I bonds. The rates that they're paying right now, I think, are in the range of about 7%, 6.89%. So that's a lot better than you could get at a bank. So people really like these I bonds, but there's a limit of $10,000 a year that you can buy electronically. But you can get another $5,000 a year of I bonds if you have your tax return refunded as I bonds. But to do that, you have to fill out a special form. I tried doing it last year, and it took them 8 months to process my request. So it's really, really slow. If you do anything other than like electronic filing and electronic deposit, that's fast. If you do electronic filing and electronic deposit, you'll probably have your money within 2 weeks. But if you file on paper or you're asking for them to send you bonds, it could take 8-9 months before you get your money. So it's kind of frustrating that it's that way. And what's super frustrating, I filed on paper last year, which means instead of like typing all this into a computer and clicking send so that it goes to their computer, I printed out paper forms and I had to mail them to an IRS office, and someone types them back into a computer again, those printed forms. It's like they don't even use a scanner. It's a human person that has to type everything back into the computer again. It's just absolutely barbaric that it's still that way, but I mean that's the system as it stands right now. One of the interesting things, you know, the president of our university right now, Brad Smith, he previously worked for Intuit, which makes TurboTax software, among other products. And so there's been some criticism of the software tax preparation industry that like they have lobbyists that are trying to make the tax system, they like complexity. Like they don't want the tax system to be simple. They don't want the government to make it easy for you to file your taxes, because then people wouldn't use those software products anymore. There are some other countries where the government actually files your taxes for you, and then they just send you like a postcard that tells you, here's how much you earned, here's how much you owe, send us the check. You know, like they prepare the bill for you, and most companies do that. Like if you think about your water bill or your electric bill, I mean, they just send you a statement and they do the math for you. But for some reason, our system is that they have the individual people are responsible for filing the tax return, and it doesn't have to be that way, but it is, because I think of special interests who are able to exert political influence in Washington and kind of keep our system complicated and broken in an unnecessary way.
It kind of makes me think, like, would a flat tax fix that complexity?
Oh, it would be a lot simpler if it was a flat tax. Now, the argument against a flat tax is that people say people who earn more should carry like more of a burden. And in a flat tax, they pay more dollars, but they don't pay more proportionally. So like a flat tax isn't progressive. Like this is progressive, you know, but then flat tax proponents will say, but if you have a flat tax, then what you do is just have no deductions. And I think that'd be great. Like if there was no deductions whatsoever, then it would be really easy to calculate things. Because right now, one of the biggest deductions that people take is mortgage interest is deductible. So you have an incentive to not pay off your house because the interest that you're paying on your house is tax deductible. And there's also an incentive to buy a bigger house than you need, because, you know, even if you do have to pay a lot of interest on a big giant jumbo mortgage, the interest is deductible. So it's like you didn't earn the money that you have to pay towards interest. And so a lot of people criticize the mortgage interest being deductible as kind of fueling America's appetite for McMansions and you know, unnecessarily large homes that have a big like environmental footprint and kind of chain people to their jobs with unnecessarily large mortgage payments when if these incentives weren't in place to overconsume, then people maybe would only buy as big a house as they need to live in without thinking maybe in the back of their mind, well, I should get a big house because the mortgage interest is tax deductible, you know. So, I mean, it's a complicated thing, but the main argument that people say about flat taxes is that rich people wouldn't pay their fair share in a flat tax. But, I mean, they're not paying their fair share now because there's just so many loopholes and deductions. Yeah. Other questions about taxes, income taxes? So I don't mind paying my taxes. Honestly, I don't. And the tax actually each year that I kind of enjoy paying is my property tax. And the reason why I say that is that I feel like my kids got a good education. You know, they live here, one of them lives here, one of them used to, in Cabell County. And so I'm only paying like around $1,000 a year in property tax, and their education was worth way more than that. Like if you send your kid to private school, even a very inexpensive private school like here in town, St. Joe's, I think they charge around $5,000 a year for tuition. But I mean, there are private elementary schools that charge $20,000, $30,000 per pupil. And so, I mean, $1,000 for 2 students in the schools is just a bargain. So I don't mind paying my property taxes, especially because it's going towards other things like, you know, police protection as well, and the libraries and the health department. And I've used all those services in the past. Income tax, I wouldn't mind paying. I mean, I'm happy to pay my fair share, but a lot of people don't. And that's when I think resentment arises, is when people realize that some people are cheating on their taxes, and then they think, well, I shouldn't have to pay taxes either. And there's a philosophy, some people think, there's a school of thought that's called starve the beast. And starve the beast philosophy is that if the government isn't efficient, then what you should do is you should try and cut taxes so that the government doesn't have enough money to do its functions anymore. But my feeling has always been that, like, if the government has problems, let's fix the government rather than like play games with the debt ceiling or like political grandstanding about overspending and how that means that we should lower taxes. I mean, if you want to live in a society that has benefits and where there's stability, then I think there's always going to be taxes that have to be due. And there are lawless places where people don't pay taxes, but I wouldn't want to live in one of them. So anyways, that is it for taxes. Let's just take one last look at these exam-related announcements. Our test is on Tuesday from 4 to 6. Does anybody have questions about the parameters of the exam? I've graded the last 2 assignments and about half the projects already. Several of you submitted your projects early, so I went ahead and graded about half the projects so far. They look great. So you should be going into the test with a pretty clear idea of what your average is up till now. But if you have any questions as you study, or if you want to go over anything, just let me know. Otherwise, I'll see you for the exam on Tuesday.